Oh, I know that sound. It's time for the Beer News Report. Hi, and welcome to the Beer News Report. Cheers. I still got the red background. Still listening to your feedback, seeing if you like it or not. And after seeing last week's show called Recession 2021, some of my friends were asking about options. They want to know what they were, how do you use them. Now, I love options. That's pretty much all I trade in. But if you're not thrilled about investing or math or talking about money, then this show's not for you. If you're kind of curious, crack open a beer, start folding your clothes out of your laundry basket, and put this in on the background. And if you want to know what options are, then grab a pen and pad and start taking notes. Because today we're going to talk about options. Cheers. First thing you need to know is that I'm no longer a financial advisor. 9/11 pretty much put an end to that career. But I have taken several courses on investing. I've taken investment courses from Wade Cook, Optionetics, Online Trading Academy. Plus, I've read a ton of books on investing. And I'm actually leaning now towards Online Trading Academy because they have computers in the classes and you can simulate doing trades in this non-monetary account. So you kind of get a feel for what trading is like. But any of these courses will work, and I gotta warn you, they're expensive, and you have to like trading and doing basic math. Otherwise, just don't do it. If you're not willing to put in the time, options will destroy you. They are very unforgiving, and not for the people who don't like risk. And I can't stress this enough. Don't do options on a whim. Learn how they work, and then do your homework, because options can make you poor quickly. Cheers. Okay, you still with me? What are options? Options are not stock, but they're contracts that let you buy or sell a set of stocks. And each contract is for 100 shares of the underlying stock. And underlying basically means that it's the stock that you're interested in. There's two types of options. There's the call option and the put option. The call option is if you want to buy because the stock's going up. And the put option is because you think the stock's going down. Here's an easy way to remember this. Think of an option like a date, right? So if I'm going on a date, I have to call the girl up and ask her out, right? So I'm going to call up. Now let's say we go on this date, we get in a big fight, and I'm no longer interested in this girl. So then I'm going to put her down, right? I'm going to end the relationship. So put down. So again, you call up or you put down. It's not that hard, right? Cheers. Okay, the next step is to find a stock that you're interested in. Let's say it's Apple. Let's say that you think with Christmas coming that the stock is going to rise because people are just going to buy a ton of Apple products. You want to buy some shares, but the current price of Apple is around $112, and all you have is $1,200 to invest. So you could buy 10 shares of Apple for $1,120, or you can look at the January call options for Apple at $112.50 because that's the closest option price. So looking at the chart, we see that the $112.50 January call options are selling for $11.20 a contract. But remember, each contract is for 100 shares of stock. So the actual cost for one contract is $1,120 because that's $11.20 times 100. Now, you wait and see what happens as it gets closer and closer to Christmas. Let's assume you've guessed it correctly and Apple shares are very strong during the holidays. Then the stock went up 10%, meaning it's now valued at $123. If you had bought the 10 shares of stock, that means you would have made 10% on your $1,120 investment for a profit of $112. Let's look at the Apple $112.50 January call options. You sold them right before Christmas for $12.20. That gives you a profit of $1 per contract. You had 10 contracts, so a total profit of $1,000, which is almost 10 times what you made with just the stocks alone. So what's the catch? It can't be that easy or everyone would be doing it. That is so true. Cheers. Okay. The catch with options is the time limitation. Now you have a certain amount of time for the stock to do what you want it to do, or the option will drop to zero. So, our example, if Apple did not have strong sales and did not go up, then the option would lose value. So let's do our example again, but this time Apple stock doesn't move. It just hovers around $112. Well, then the 10 shares of Apple stock just stay there, and your 1,120 investment, it stays at 1,120. You didn't gain or lose anything. But your January 112.50 options start losing value. Start losing slowly at first, probably drops $1 each month until you get to January. That's when the option really starts to drop. Why is that? When you bought your January options in September, there's 4 months between when you bought them and when they expire. Expire means they've reached the date on the option, and you have to either sell them or the market will close them as worthless. Options will gradually go down in value as time goes by, usually by a small amount each month until you get to the last month. Then it goes down fast until you get the expiration date. And I'm only talking about the time value of the option, not the intrinsic value. Has that ever happened to me? Oh yeah, many times, because the stock market is hard to predict. And also, every now and then you have this streak of good picks and you think you can't make a mistake. And that's when you cut back on the homework, you don't do the research, you just buy the options because you know you can't be wrong. That's when the market slaps you hard in the face saying, don't you ever take me for granted. And you give her the respect that she deserves. Cheers. All right, that was call options. Now for put options. They're pretty much the same as call options. We're going to make money as the stock goes down. Let's say that you bought 100 shares of Tesla when it was cheap. And if you did, I mean, you did great. That was a good buy. Cheers. Okay, you have 100 shares of Tesla and the stock has taken off. And it's gone all the way to $2,000 and more. Now, you're kind of nervous because it's gone up so much in a short amount of time. So you're thinking maybe it's overvalued. You don't want to lose the stock because, you love Tesla. So you want to protect that investment. So this is where a put option comes in. You can buy a Tesla put option for a certain length of time to protect your stock if it's going to go down. It's sort of kind of like insurance for stock, right? So now you have the contract for, let's say, 4 months. And if the stock drops, your put option will protect you from the loss, minus the cost of the put option. Of course, if the stock goes up or stay where it is, then the put option is going to expire worthless. But hey, at least you didn't lose any money on the stock, right? Cheers. Now let's say you're pretty sure the stock is going to go down. We're no longer talking about Tesla. It can be any stock that has options on it. And you want to have a put option on this to protect it going, from losses going down, but you don't actually want to pay for that put option. Is that possible? Yeah, definitely possible. So now we're getting a little more advanced because you have to use both types of options in conjunction. So let's say you own 1,000 shares of company ABC and the stock has gone up dramatically and it's actually starting to come down, right? So you're thinking it's going to come way down because it's gone up too fast. So now you want to protect it and you're going to buy a put, and the put costs $1.50 per contract, and you times that by 1,000, so that's $1,500, right? And you're like, dang, that's $1,500. I don't want to pay that. How do I get these put contracts for free? Because I like free stuff. I mean, who doesn't? Cheers. What you do is you look up the price of the call options because you're going to sell them. Now wait, don't you have to first buy the call option before you can sell it? No. Isn't that crazy? This is a market. You can buy or sell before anything happens. If you sell before you own it, that's called shorting. And you can do that with stocks or options. But I got to make one thing clear. When you buy an option, you have the right to, if it's a call, you have the right to buy the stock at a later date at the price listed on the option. But you don't have to. But if you sell a contract, an option, whether it's a put or a call, if you sell it, you have to do what's on that. So in other words, you are promising to give away your stock at the price listed on that call contract. Again, if you buy an option, you have the right to do whatever it says you do. If you sell, you are obligated, you are required to do what the option tells you to do. That's a critical distinction. So, okay, you have 1,000 shares of this company, ABC, and you've already done the put for $1.50, so you spent $1,500. Now you need to get $1,500 back to cover that? Well, you look at the calls and you look at the same time frame that you did with the puts, and lo and behold, they're $1.50. So if you sell them, that'll be $1,500 into your account, and that'll cover the cost of the puts. So now you get your stock protected on the way down, and it didn't cost you anything. So if the stock goes down like you predicted, bada bing a boom, you've made it, you've covered yourself, you take no loss, you get that dividend, and everything's hunky-dory, right? Well, that sounds great. I want to do that all the time. Cheers. Now, let's look at it from the other way, like we did with Apple and all the other ones. Let's say the stock only went down a little bit and then went back up. With the put, as we talked before, you just lose the money of the put, right? Because it didn't go down, it went up. Or let's say even if it hovered, you lose the money of the put. But that's okay because we paid for it with the call option. If it goes down, we make money. If it stays flat, we didn't lose anything, we just break even. And our only problem is if it goes up. So if it goes up, what happens then? When it goes up, the put option goes to zero. It's worthless. You lost that. Now the call option is no longer worthless. It's worth the value of your stock. But what if out of the blue, some company says, hey, I'm going to buy this ABC company and I'm going to pay $30 extra per share. So the stock jumps $30. Now you're in trouble, right? Because those call options are now $30 and you got 1,000 of them. So you have two choices. One, you let the call option go to term, it expires, and the market will sell off your shares of ABC to cover that call option. They do it automatically. Then you lose the stock. Or you buy back the call. Yeah, you can do that. You can, if the stock jumps up, you're like, okay, I'm just going to buy it back. It's going to cost you $30,000, but you can buy it back, and you didn't lose your stock. So is that good or bad? Well, let's have a drink on this and think about it. Cheers. All right, so in this scenario, we're going to buy back the option for $30,000. Now the stock went up $30. So if you think about it, you've made $30,000 on the stock, but to cover the call option is going to cost you $30,000. So you actually broke even. What happened is you drained the cash out of your account. That's the downside. You've kind of like, you've just made your stock more expensive from the initial basis price that you paid. And if you can do that, that's fine. And, you know, because you like the dividend or you like the stock. Like I said, if you goof up with options, they can make you poor really, really quickly. And this shows you, right? In no time flat, you just lost $30,000. So always, always do your homework and be careful with options. Cheers. So that was a basic look at options. And I kept it light because options are tricky. And you should not use this video as your training for options. You really need to take a course or find someone who will mentor you. Now, like I said, I love options and I do them all the time. I've been doing them since 1994. And I've played around with several strategies. I know all about iron butterflies and condors and all that stuff. Those are my favorites. I found ones that I like, and to me, that's key. You find a strategy that you like to do that's comfortable for you and stick to it. Become an expert at it. I keep notes and spreadsheets on all my trades. I also learned how to read charts. This takes practice, but over time you should be able to see trends that happen with the stock. Now, if this has confused you and you don't understand options-driven stocks, then just stick to mutual funds or ETFs. I prefer ETFs over mutual funds. But you should have some money in the stock market because it's the best place for investments out there so far. I haven't found anything that beats the stock market. But if you can, you should put some money in the stock market. So here's to the stock market. Happy trading. Cheers. Well, as you can see, my beer is almost empty. That means we're at the end of the show. I hope you enjoyed it and learned something. If you'd like to send me a comment, please do that on this email. I appreciate it if you click the like button, and if you want to subscribe, you'll get notified when I have a new show. It usually puts a little dot when you go onto YouTube on the channels that you subscribe. And always, keep your beer cold and yours just hot. Cheers.